Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser, and today is actually our first video of the year, so welcome back. We have a lot to get into. We're going to talk a lot about just kind of what market movements we've seen from the start of the year until now, talk about some fundamental underlying areas of the economy that we should at least be kind of keeping our eyes on, and just kind of broadly discussing where we were and kind of where we're going. And so much of the moves in the market that we've seen, which if you've not been following along, have been quite positive. Markets have had a fairly strong start to the year. S&P 500 as of Friday's close was up over 6.5% year to date, which is a pretty stark change to how we started out last year. So the question is this going to hold? And so much of this really depends upon the Federal Reserve's ability to deliver this promised soft landing to the economy. And so during periods of economic slowdown, typically we go into recessions, which tend for the short term to be very tough on stock markets, tough on the economy. And so this time the Fed claims that it's going to be different. We're having a soft landing and we're going to be able to avoid that crash landing, avoid that crash recession. Right now, some are saying, hey, we've already avoided that. Those first 2 quarters of 2022, that was just a slowdown, but we were able to avoid it, land softly, despite all of these interest rate hikes to try and quell the inflation that was running unchecked all year last year, which was really the start of the economic downturn that we had last year. And so just again, will we avoid a recession? We don't know. I'm going to talk to you a little about what we've been seeing in the fundamentals, things to keep an eye on. But just to kind of talk about where are we right now year to date, obviously we've had some pretty strong performance. The S&P 500 as of Friday was up 6.2%. The Dow was up 2%. NASDAQ was up 12.6%, which, as you remember, the NASDAQ was hit extremely hard last year, harder than the other indexes. And that's not surprising because when we talk about NASDAQ being more tech heavy, more growth heavy, those are areas that really take it on the chin when we talk about having to raise interest rates, making the cost to borrow money more expensive, always much more difficult on growth companies. And that's why value companies really shined last year. And then quite a big change from last year, just right now, is the commodities index is actually down 5.5% year to date. Now, again, that had a great year last year. Again, not surprising when we saw things of what was going on with energy. So what's going to be interesting is to see if these patterns hold or if we're just kind of seeing a temporary kind of bull market trap. And if we get into this next chart here, looking at the S&P 500, I went back just 1 year so we can kind of take a look at where we've been and possibly where we're heading. And so, as you remember, this time last year, as we came into April, is when we really started to things begin to compensate within the stock market. We had a couple of rallies. We actually came up and we kissed the 200-day moving average here, but we couldn't hold it, sold off again into the fall. And then it wasn't until around November that we started to kind of see the market begin to correct in a positive fashion. Now, something that's important to note here is this crossing of the 50-day and the 200-day moving average in a rising market like this is actually a very bullish sign. It's a good sign for markets. It's typically a sign that things are about to improve, that we've put a bottom in. So be interesting to see if that holds. You remember last year we talked about the death cross, and so that was quite the opposite. As markets were beginning to decompensate, when we saw those averages cross last time, that was actually a negative sign for the market. And so again, we've been kind of holding steady here. This 4,000 mark on the S&P 500 here is a very important line of support for us to watch. So we've had some weakness last week. Today, which is Tuesday, has actually been a pretty weak day for the market. S&P's been down over 2% for most of the day. So it's going to be interesting to see. We really have to hold around 4,000 here. Now, if we are able to hold here and then continue on, then it's more favorable again that we could go on to see new highs. And again, gives us a little notch in our belt that maybe the correction of last year could possibly be behind us. So this is a really important place to be watching right here. Just looking at relative strength, RSI numbers, we're only at 52, so that's not a crazy oversold number. So again, after last week, had some weakness here. Not surprising. We were pretty topped out coming into last week. Now looking at Dolly, and out kind of our asset allocation model that we like to look at. It just kind of gives us a snapshot of where things are. We've seen some pretty big changes since the beginning of the year that I wanted to show you. So you'll remember last year commodities was far and away the number one sector that you might have wanted exposure in, and that's dropped all the way down to the 4th position. International equities kind of very quietly at the end of last year leapfrogged over into the number 1 position. And so this is the first time that we've seen international go into the 1st position and to be able to hold it for a period of time. So we've been watching that. Cash is in the number 2 position. Again, very interesting. It's not very common for us to have international equities, then cash, then domestic equities as number 3. So again, things that we're watching, we've seen there's been a kind of a lot of movements. So I think we're going to have to wait and see where things are going to settle. And again, kind of coming back to the idea of, are we in a new bull market, or has this all been kind of a bear market rally coming out from December? And there's really, the verdict isn't really in yet. There's a case for both, and depending on which analyst you speak to, they may have very stark opinions over whether or not this is a new rally and kind of the corrective process from last year is over, versus no, we're actually still in this prolonged correction, but this has been just a bear market rally. And so really nobody really knows. We can kind of take the information that we have and kind of make some guesses, or at least try to take the information we have and use that in our portfolios. But again, thought this was very interesting. So looking at domestic equities, mid-cap and mid-value blend remain to be very strong areas. Last year, this has still not changed. Mid-cap value was in that number 1 position for quite some time. And then small blend, large value, growth names still kind of lagging over here. Looking at the sectors, not a huge change over here, except for we've seen technology move up from where it was in red all year last year to now. Basic materials, financials, and industrials, they've kind of all been in those strong areas ever since even last year. So haven't seen a huge amount of sector changes, although energy has been decreasing in strength. Not surprising when we look at the fact that commodities has fallen so far from its reign last year. Fixed income and then currencies lag behind. So just a couple of fundamentals that I think is important for us just to kind of know. One thing, it is concerning when we look at some of these numbers, one being how much revolving debt has been increasing for Americans. And so you can see back here in 2020 to now, so we are over leveraged again. What does this mean? It means that people, they're having trouble paying for their bills. They're relying on credit cards much more than we were relying on them 2-3 years ago. And so that could be problematic for the market. It's not surprising when we look at still the fact that interest rates have gone up and inflation is still higher than where we were before. But something to keep an eye on is the fact that we were seeing credit card revolving debt increase very quickly. Same thing, debt-driven consumption. So looking at how much of what's being purchased in the economy is being purchased by credit cards or other revolving debt. And again, significantly more than where we were in 2020. That again means that people, the goods that they're consuming, more and more of them are needing to go on credit cards. And so again, that is typically a sign for, that there could be some fractures within the economy when we look at the way that Americans are spending money. Inflation adjusted retail sales. So this number, I actually just saw this chart today, and this to me is probably one of the most concerning. Looking at how retail sales have absolutely flatlined over the last couple of months. And so we see this, now remember last year and in 2020, 2021, we had a huge pent-up demand, right? We couldn't get anything back over from China. We wanted to buy things faster than they could get them to us, okay? And so we saw this huge surplus here, but now things have evened out. Things are more expensive. We're having to put more of the things that we're buying on credit cards, and what we are buying, retail sales are dropping. So these are all potential signs. I'm not saying that these are signs we're definitely going into a recession, but these are definite signs that point to the potential for economic slowdowns and things that we should at least be keeping an eye on. And I just used my pen by accident here. I'm just going to escape. And then the last slide I just want to show real quick here, looking at in 3-month cycles, average growth for employment. So we just had a banner jobs report that came out last month, but you really need to look at it under the hood here. So remember in 2020, everybody was filing for unemployment faster than had ever seen prior. Then that was a very short-term issue, and then again we saw huge jumps in jobs. Well, when we look at these rolling 3-month averages, you can see these are really beginning to trend down, and so this is something to keep an eye on, that job growth is slowing down. And again, do these types of fundamentals tell us that there's definitely a recession coming? No, but I think it's important we look at the technicals, and technicals are actually very reassuring. When we look at things like the Golden Cross, when we look at the fact that we've been able to hold important lines of support. So, sometimes technicals and fundamentals don't always line up. It's just really important to make sure that we're taking kind of everything into account as we're making educated decisions for portfolios. So kind of putting that all together, I think that this is kind of a great time at the beginning of the year. This is kind of the time that you really want to make sure that you understand the purpose for your portfolio. Is it a short-term, intermediate, long-term? And then once you determine that, it's really important for you to take a look at your allocations and understand why you're holding them. So within our models, we made some pretty significant changes at the end of the end of the year, kind of coming into the new year. And so we were pretty purposeful in why we chose some of the areas that we chose. And so you want to make sure that all of your positions have jobs. And if they're no longer performing their job, you have to be willing to unequivocally cut them unemotionally and replace them with another position that's going to be able to do that. And so you can look at areas like relative strength, look at areas that seem like they're kind of strengthening versus areas that seem like they're weakening. So those are things that a fiduciary investment advisor can kind of help you put together. But this is, as we've seen a lot of flip-flopping, as you saw back with Dolly, we've seen a lot of leadership changes. So these are kind of the times that sometimes it makes sense to be able to kind of take a look at your portfolio and say, hey, did my leaders become laggards? And if so, I may need to consider making some changes. And so that's kind of how we typically approach things, just always looking at things with a fresh lens, making sure, because the market never stays the same. Markets are going to continue to cycle, so the important thing is to try to kind of be able to understand where those cycles are likely heading next so that you can try to capitalize for your growth. So I thank you for tuning in today. If you have any questions, this is my contact information, victoryfiduciary.com. All of our other videos and blogs are there. You can always give me a call or email me. We're always happy to take your questions, or if you have specific feedback, always like to take that. So glad that you spent the time with us today. Hope you have a great day, and we will see you next month. Take care.